This LOS is distinguished between costs that are capitalized and costs that are expensed in the period in which they are incurred. We'll start with an introduction to this LOS. Long-lived assets, also referred to as non-current assets or long-term assets, are assets that are expected to provide economic benefits over a future period of time, typically greater than 1 year. Long-lived assets may be tangible, intangible, or financial assets. I put that financial assets in bold green. Sometimes students and candidates forget about the long-term financial assets. Examples of long-lived tangible assets, typically referred to as plant, property, and equipment, and sometimes as fixed assets, include land, buildings, furniture and fixtures, machinery and equipment, and vehicles. Examples of long-lived intangible assets, assets lacking physical substance, include patents and trademarks, and examples of long-lived financial assets include investments in equity or debt securities issued by other companies. The scope of this reading and the LOS that are going to follow is limited to long-lived tangible assets and intangible assets. The first issue in accounting for long-lived assets is determining its cost at acquisition. The second issue is how to allocate the cost to expense over time. That's through depreciation or amortization or depletion. The cost of most long-lived assets are capitalized and then allocated as expenses in the profit or loss income statement over the period of time during which they are expected to provide economic benefits. The two main types of long-lived assets with costs that are typically not allocated over time are land, which is not depreciated, and those intangible assets with indefinite useful lives. Okay, this is a nice to know, not a need to know. I put in some IFRS references. This is not exactly in the CFA text, but as you're reading through the reading on assets, if you want to go back and look at any IFRS reference materials, then these are the standards. International Accounting Standard 16 is plant, property, and equipment. International Accounting Standard 17 is with regards to leases. International Accounting Standard 28 is with regards to investments in associates. This is not being covered in this LOS. We're looking at tangible and intangible long-term assets, okay? So, which is really IAS 16, PP&E, that most people are familiar with, and International Accounting Standard 38, which is the intangible assets. Finally, as we've seen before in a previous LOS, and it's worth mentioning, is that under IFRS, there's International Accounting Standard 40, which gives us the guidance with regards to investment property. Investment property being a class of asset under IFRS, but not under US GAAP. Okay, so that's just there. Sometimes you like to go outside of the readings a little bit to get a bit of extra information. So I just thought I'd put in the IAS standards with regards to long-term assets. Okay, just some key terms on PP&E. I did this with regards to some key terms in inventory, and I like to remind candidates that a lot of the CFA test is English test subject accounting in this case, and it's important to go through the glossary and be up to speed on all the vocabulary, especially if English is not your first language, okay? So I just put this in as a little helpful. It's a nice to know. Again, that's not a total need to know as per the LOS. So property, plant, and equipment, those are tangible assets that are held for use in production or supply of goods and services, for rental to others, or for administrative purposes, and are expected to be used during more than one period. Cost is the amount paid or fair value of other consideration given to acquire or construct an asset. So don't forget, we can exchange land for shares, okay? And if those shares had a market value, that would be the cost of our land. Useful life is the period over which an asset is expected to be utilized, or the number of production units expected to be obtained from the use of asset. That's when we're doing depreciation using the units of production method, for example. That's how we expense the cost of that asset over the life of it. Residual value of an asset is the estimated amount less estimated disposal costs that could currently be realized from the asset's disposal if the asset were already of an age and condition expected at the end of its useful life. Depreciable amount is the cost of an asset less its residual value. Depreciation is the systematic allocation of the depreciable amount of an asset over its expected useful life. And finally, fair value is the amount for which an asset could be exchanged between knowledgeable willing parties in an arm's length transaction. Plant, property, and equipment, measurement at recognition. An item of property, plant, and equipment that satisfies the recognition criteria should be recognized initially at its cost. The standard specifies that cost comprises purchase price, including import duties, non-refundable purchase taxes, less trade discounts and rebates, costs directly attributable to bringing the asset to the location and condition necessary for it to be used in a manner intended by the entity. Initial estimates of dismantling, removing, and site restoration if the entity has an obligation that it incurs on acquisition of the asset or as a result of using the asset other than to produce inventories. So you can see those first two bullets there, the purchase price and the duties, the non-refundable, and the cost directly attributable to bringing the asset to the location. That's exactly the same as the LOS for inventories, because inventories are an asset, PP&E are an asset. So the measurement at recognition, there's some similarities. The difference here is that with PP&E, there might be some initial estimates of dismantling, removing, and site restoration. Okay? So examples of directly attributable costs include employee benefits of those involved in the construction or acquisition of an asset, cost of site preparation, initial delivery and handling costs, installation and assembly costs, costs of testing, less the net proceeds from the sale of any product arising from the test production. That's a little tricky one. Borrowing costs to the extent permitted by International Accounting Standard 23, borrowing costs, and professional fees. So just carrying now with plant, property, and equipment measurement at recognition. So here's some examples of the costs that are not, I put in bold, not directly attributable costs and therefore must be expensed in the income statement. Costs of opening a new facility, often referred to as pre-operative expenses. Costs of introducing a new product or service. Advertising or promotional costs. Well, that one makes sense. I don't think anyone would want to capitalize advertising expenses. Costs of conducting business in a new location with a new class of customer. Training costs, administrative and other general overheads. Costs incurred while an asset capable of being used as intended is yet to be brought into use, is left idle, or is operating below full capacity. Initial operating losses. And finally, costs of relocating or reorganizing part or all of an entity's operations. Now we're going to look at the acquisition of long-lived assets, starting with property, plant, and equipment. A key concept in accounting for expenditures related to long-lived assets is whether and when such expenditures are capitalized, included in the asset shown on the balance sheet, versus expensed, which is treated as an expense in the period on the income statement. When property, plant, or equipment is purchased, the buyer records the asset at cost. In addition to the purchase price, the buyer also includes, as part of the cost of an asset, all the expenditures necessary to get the asset ready for its intended use. For example, freight costs borne by the purchaser to get the asset to the purchaser's place of business and special installation and testing costs required to make the asset usable are included in the total cost of the asset. So we've seen that before. I'm kind of repeating myself, but it's just to cement that in, that you need to include all the costs to get the asset into the place of business, installation, and testing. Subsequent expenditures related to long-lived assets are included as part of the recorded value of the asset on the balance sheet if they are expected to provide benefits beyond 1 year in the future and are expensed if they are not expected to provide benefits in future periods. Expenditures that extend the original life of the asset are typically capitalized. So, for example, that's if I have a fleet of trucks and I put a new engine into a truck that has a $10,000 value, for example, I don't expense that. It's going to extend the life of the truck, so I'm going to capitalize that, okay? So any expenditure that extends the original life of the asset are typically capitalized. That's an important point to be aware of, especially if there's any calculations that need to be made later on. When a company constructs an asset or acquires an asset that requires a long period of time to get ready for its intended use, borrowing costs incurred directly related to the construction are generally capitalized, and that falls under a different international accounting standard under borrowing costs. Constructing a building, whether for sale, in which case the building is classified as inventory, or for the company's own use, in which case the building is classified as a long-lived asset, typically requires a substantial amount of time. To finance construction, any borrowing costs incurred prior to the asset being ready for its intended use are capitalized as part of the cost of the asset. The company determines the interest rate to use on the basis of its existing borrowings, or, if applicable, on a borrowing specifically incurred for constructing the asset. If a company takes out a loan specifically to construct a building, the interest cost on that loan during the time of construction would be capitalized as part of the building cost. Under IFRS, but not under US GAAP, income earned on temporarily investing the borrowed monies decreases the amount of borrowing costs eligible for capitalization. So I put that in bold because often on a test they're looking for small points where there's compare and contrast. So that's kind of an important little point there, is that under IFRS, but not under US GAAP, income earned on temporarily invested borrowed monies decreases the amount of borrowing costs eligible for capitalization. And that's the last slide for this LOS. Thank you.